Howdy, Jacob here. Today we're looking at Rambus in the semiconductor and equipment industry. 6.9 billion market cap on 6.4 billion enterprise value. Looks like they provide semiconductor products globally, incorporated in 1990. Growth is pretty solid, 297 million in 2014 up to 461 million in 2023. Looks like return on invested capital and earnings are very inconsistent, however, where they have about 2 years in the last 10 of very high return on invested capital. Outside of that, pretty low and sometimes even negative due to their negative earnings. Their balance sheet shows 95 million cash on hand, 331 in short-term investments, with only 220 million in liability, all of their liabilities, and so very safe from a balance sheet perspective. Cash flow statement shows capital expenditures growing quite a bit, but as well as that, same with cash from operations, and so free cash flow is very heavily growing. Their capital expenditures increasing means that they're reinvesting back in themselves, which you can also see through the investment portion of the investing section of your statement of cash flow. And their use of cash is recently buying back quite a bit of shares, probably 50% buying back shares, maybe 40% reinvestment, and then 10% in paying down debt. But they do not have any long term or short term debt as of this moment. Let me make sure I said that right. Yeah, no short-term debt, no long-term debt. So they can focus 100% of their cash flow on reinvesting back in themselves at hopefully great returns and then buying back shares that are hopefully very cheap. They have 45 million stock-based compensation, but their share buybacks recently have been out outreaching that. Um, they've been buying back more shares than they've been issuing through stock-based compensation. So let's make some assumptions here on the revenue side. Let's see. There wasn't a crazy amount of growth, and it is pretty cyclical, as we've seen with some other semiconductor stocks. It's interesting. Some of them just increase like 20% a year, and it's just absolutely wild. Others are pretty inconsistent, where I don't know if we're seeing as wild as this, negative 40% to as high as 38% and such, but it's definitely a pretty cyclical business. So I would say that I would not be surprised if it averaged out to maybe 6% a year for the next 7 years with margins. I'm really just going to use their free cash flow margin here. So let's say 45, let's do 40 and 45%. Share change, they're $7 billion essentially, so 70 million going towards that would be 1%. And now that they've freed up the amount of cash for debt, I think that should be a reasonable assumption. Terminal P at the end of 7 years, I think that there's still going to be quite a bit of growth in the semiconductor industry. It's just whether this company is at the forefront of that growth. I would say with their current growth estimations and where I think they're going to be, I think that a 17p to me seems pretty reasonable. And at this point, we're saying that it needs to fall 71% to get the return I'm looking for. I'd say that this is an interesting company. I think it's clearly cyclical business, but I do think that there's quite a bit of growth in this industry, and I think that as the industry grows, so are many of the companies within, although that does increase competition due to increased margins. But I do think that this company is free. I know they're free of debt, and I think that due to them having capabilities and at least recent history of them buying back shares and reinvesting back in themselves, that should put them in a good spot to have some good growth going forward. So I hope you enjoyed the video, and I hope you have a great rest of your day. Thank you.